In today's episode, I'll talk about two interesting stories. In the first one, I'll talk about how Sun Pharma's latest quarterly results reveal a very big story about India's rise in pharma, the shift from generics to innovation, and how one single company is sort of rewriting the entire rules of the game here. And in the second story, I'll talk about how India's biggest oil companies are reacting very differently to falling crude prices, with upstream giants like ONGC hurting and downstream refiners like IOCL and HPCL quietly doing well. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. Something very important is happening in the world of Indian pharmaceuticals. One of India's biggest drug companies, which is Sun Pharmaceuticals, has recently declared its results for the fourth quarter of FY2025. And the reason why it's important is because Sun Pharma, being the biggest pharmaceutical company in India, really tells us what is exactly going on underneath the surface. And it also tells us a deep story about how India's pharma sector works, where it came from, and where it is headed in the future. Because when most people hear the word pharma, they usually imagine things like doctors, prescriptions, or maybe white-coated scientists in a lab. Now, of course, all of that is true, but there is a whole other side to the industry that is rarely ever seen or even spoken about. It is basically an incredibly complex global system where chemistry, public health, business strategy, and legal systems all sort of come together. It is also a sector where fortunes can be built or destroyed by one single decision from a drug regulator. And over here, India plays a massive role. We are no longer just a low-cost production hub, we have also quietly become a center of innovation, process excellence, and global scale compliance. So in order to explain what Sun Pharma's results really mean to all of us, let's first take a quick step back and understand how the pharma industry itself is structured at the very core. See, at its very core, the pharmaceutical industry is split between two types of drugs, which is small molecule and large molecules. Now, small molecules are the kind of drugs that you are most probably familiar with. These are basic chemical compounds like paracetamol. These are made through step-by-step chemical reactions, typically in Raj reactors. Now, most of the pills that we see in pharmacies and also the ones that India exports in bulk fall under this very category. But on the other hand, large molecules or biologics are far more complicated. You can think of things like insulin, vaccines, or monoclonal antibodies. Now, these are not built molecule by molecule in a lab, but they are made using living cells in highly controlled environments. They often need cold chain storage, strict handling, and are usually injected into human bodies. Now, the complexity is several levels higher than small molecule drugs. So even though both are a part of the same pharmaceutical space in general, they behave like two completely different industries within this entire space. Now, historically speaking, India's strength has been in small molecules, but over the past decade or so, we have also started inching towards biologics or larger molecules as well. And that shift is slowly redefining our place in the global pharma sector. Now, then the question is, how did India even become such a major player in making medicines in the first place? See, the answer actually goes back to our patent laws. See, normally when a pharma company invents a new drug, they get a product patent that gives it the monopoly for around 20 years. That basically allows it to set high prices and recover its research costs. But back in 1970, India changed these rules. We basically got rid of product patents for pharmaceuticals. You could not patent a drug anymore, you could only patent the process to make it. So basically, if somebody figured out a different way to make the same medicine, they could legally sell it. And this turned drug manufacturing into a giant chemistry puzzle of sorts. Indian scientists basically became expert at reverse engineering and doing jugaad with drugs, where they cracked the formula and then produced them at much lower costs. And that is how companies like Cipla and Ranbaxy, which is also, by the way, now a part of Sun Pharma, built their entire empires, which is by making affordable versions of expensive Western drugs. Now, this model was so successful that when India signed on to the WTO's Intellectual Property Agreement, which is also, by the way, called TRIPS, in 1995, we negotiated a 10-year delay to bring back product patents. And even when we reintroduced them in 2005, we added a very special clause, which is called Section 3D. Now, Section 3D basically said that companies could not get a patent for small tweaks to old drugs unless they proved that the new version was significantly more effective. This was basically a way to stop a practice called evergreening, which is where big pharma firms would slightly modify their drug and get a fresh patent which could extend their monopoly. And this clause led to a very famous case. Novartis wanted to patent a new version of its cancer drug called Glivec in India, but the Supreme Court said no. That decision allowed Indian companies to sell it for 8,000 to 10,000 rupees instead of 1.2 lakh rupees that Novartis practice was charging. And on top of this, India also kept the power to issue compulsory licenses. Basically, if a drug is too expensive or in short supply, the government can allow someone else to make it without the original company's permission. And that is exactly what happened in 2012 when Natco was allowed to produce Bayer's cancer drug Nexavar. Bayer charged 2.8 lakhs a month for it, and Natco brought the price down to just about 8,800 rupees. And the courts upheld the decision. So while compulsory licenses are rare, the threat of one basically keeps medicine prices in check. So all of this put together created a booming generics industry. India now supplies about 20% of the world's generic medicines by volume. But over time, our pharma players began climbing up the ladder over here. They moved from making simple tablets to complex injectables, from copying drugs to tweaking them in eventually making their own as well. But making a drug is only a small part of the journey. There is a whole value chain involved in this process. It starts with drug discovery. See, this is where new molecules are found, but the odds here are brutal. Less than 1 in 10,000 compounds are actually going to become a drug ever. That stage is mostly dominated by global giants because it takes billions of dollars and even decades of work to get there. Indian companies rarely play at that level. Anyway, once a potential drug is found, it goes through preclinical and then clinical trials where it is tested on real patients. Now, India is a big player here, but not necessarily in a good way. We are often the cheaper place to test drugs because we have large and diverse patient groups and good knowledge of global standards. Companies called CROs or contract research organizations manage these trials in India. Anyway, next comes the production of APIs, not the tech ones, but active pharmaceutical ingredients. These are basically the actual molecules that treat your illness. Now, India is one of the biggest API producers globally, but there is a catch here. For many APIs, especially the raw chemical components which are known as KSMs or key starting materials, we rely heavily on China. Around 70% of our bulk drug imports come from there itself. And that dependence became a serious concern during COVID days. And ever since then, India has been trying to build local capabilities through government incentives. Anyway, moving on, once the API is made, it's turned into the final product, and this step is usually called the formulation stage. This is where companies like Sun Pharma come into the picture. They take the raw drug and they turn it into pills, syrups, eye drops, or injectables for that matter. And many of their facilities are certified by US and European regulators like the FDA or EMA. Now that is important because without that approval, you cannot export to those countries and therefore it impacts business. But this also means constant scrutiny. One bad inspection can shut down a plant completely. Indian companies for that matter have had their fair share of problems in the past regarding it, but the good news is that they have gotten much better at meeting global compliance standards. Anyway, after manufacturing comes branding and distribution. In India, drugs are often sold as branded generics, which is the same molecule but under different brand names. Now, your doctor would still prescribe based on the brands and not the generic name of the medicine. And this has led to a highly competitive and somewhat murky ecosystem here. Companies send out thousands of medical representatives to get doctors to favor their brand. Now, to give you a reference point, abroad, mostly companies compete on price, but in India, it's all about brand loyalty. Distribution in India is like a logistical marathon, to be honest. There are more than 12,000 stockists and more than 2.5 lakh pharmacies across the entire country. And biologics or large molecules require special cold storage. Inventory systems are tightly regulated, and new players like, let's say, 1mg and Netmeds are starting to shake things up here as well. So that was more about the landscape and what's exactly happening in this space. Now, with that understanding in place, let's very quickly come back to Sun Pharma and their latest results. See, Sun Pharma, like I said, is the biggest pharmaceutical company in India. In fact, they are one of the top 4 generic drug manufacturers in the entire world. But lately, they have also been trying to move beyond that category. Now, generics earlier used to be their bread and butter. Now, it's of course a solid business, but the problem is that it is incredibly competitive. And that is because since multiple companies make the same drug, prices drop very quickly and the margins are razor thin. So Sun Pharma has been shifting gears right now. They have been investing heavily into specialty drugs, which are complex formulations used for chronic or serious conditions like, say, cancer, autoimmune diseases, or several skin disorders. Now, these drugs are much harder to make, they face less competition, and they have much higher profit margins. In the quarter that ended in March 2025, Sun Pharma posted a revenue of about 12,800 crore rupees, where they grew about 8.5% from last year. But more importantly, their earnings grew even faster. EBITDA jumped 22.4% to 3,700 crore rupees, and margins improved to 28.7%, which is among the best that we have seen in the recent quarters for them. Their adjusted net profit was also inching towards 2,900 crore rupees, which is up 4.8%. But that said, their reported profit fell to 2,149 crore rupees because of a one-time 2,597 crore rupee write-off on their investment in Lindra Therapeutics. antibiotics. Now that's an accounting hit, not really a business issue, so it should not worry anyone too much. And when you look at where the money comes from, it is split into roughly three parts. About one third comes from India, another one third comes from the US, and the rest one third comes from global markets and their smaller API manufacturing businesses. Their India business is still rock solid. They are the market leader with about an 8.3% market share, and they grew faster than the overall pharma market this particular quarter. Now, this is not just having scale, mind you, it's also about the depth that they have. Sun Pharma leads in 13 different therapy areas, including heart disease, diabetes, skin conditions, and even mental health. And this quarter alone, they launched 10 new products. On the other hand, their US business is under some pressure though. Sales in the US fell by around 2.5%, and I know while that may not sound like a lot at first, it is notable. The problem is actually in the generics business in the US itself. Prices keep eroding because of fierce competition, because when a drug goes off patent in the US, prices can crash by as much as 90% in just one single year. That is basically just the nature of how the market operates. But that said, Sun Pharma also faced some new competitors entering and cutting into their market share. But they were very clear in saying that this was not a broad collapse, it was very specific to certain products. And that is exactly why their move into specialty drugs matters a lot more. Specialty products now make up 20% of their global revenue, which is up from 15% just a few years ago. Their flagship specialty drug called Ilumya saw a 17% growth in full year sales. And two more specialty drugs are also on the way, one for hair loss and one for skin cancer. Now both of them have US FDA approval and they are expected to launch as early as FY 2026. Sun Pharma is also investing about 800 odd crore rupees to bring them into the market in the US this year. And behind all of these, their R&D pipeline has 8 more specialty molecules in clinical trials and dozens more in earlier stages. In fact, over one third of their entire R&D budget is now going into specialty itself. So all of this basically shows that Sun Pharma is very actively evolving to stay afloat in the very difficult generics market of India and the world. And that in many ways mirrors the broader story of India's pharmaceutical industry as a whole. On that note, let's move on and talk about the second story of the day. India's energy sector, like most other countries, is massive, it is complicated, and it is critical to how our economy functions. But when most people think about energy, they don't really think about it in parts. They see the petrol pump, they see cooking gas cylinders, or the electricity bill, but they don't really think about what goes into making all of that happen. So before I get into why exactly I'm even talking about this, let me quickly break down how this entire sector actually works, because this is important context for what I'm going to be talking about. You can think of it in two broad parts. The first part is the fuels that we extract from the earth, which is things like crude oil, natural gas, and coal. Now, this part of the industry is called upstream because it is a very start of the energy value chain. These are fuels which are used in many ways, like running vehicles, generating heat, and even creating products like plastics and fertilizers, and of course, also to generate electricity. And once we've pulled these raw fuels out of the earth, the second part of the process comes in, which is converting them into something that we can actually use. And this is where companies refine crude oil into petrol or diesel, or where natural gas is transported and sold for use in homes and factories. Now, this part is called downstream, and it is what brings the final usable energy products to our homes, offices, factories, and even vehicles. Now, all of this is important context to understand what's exactly happening right now in India's oil and gas sector, because depending on whether a company is upstream or downstream, its fortunes can move in completely different directions when global oil prices change. And recently, these prices have changed quite a bit. The context here is that crude oil prices have been falling. After reaching highs of over $110 per barrel in 2022, they are now down to about $60 to $70. And for a brief moment recently, prices even dropped below to $60, which is a massive swing in just a couple of years. And it's not random, mind you. The demand for oil is slowing down, especially in countries like China. And at the very same time, supply is rising with the US ramping up production. Plus, there is a lot of uncertainty around how fossil fuels will remain in demand as the world transitions to greener energy. And add to that the unpredictable moves by countries that form OPEC Plus, who influence oil supply and prices globally, and basically you get what is a very unstable situation across the entire world. Now in India, the demand for oil has actually shrunk for 3 straight months. So there is no obvious boom coming anytime soon, to be honest. So the question is, what really happens when oil prices fall like this? See, for companies like ONGC, which explore and extract oil, it is definitely bad news. Their entire business model relies on selling oil, because if prices drop, Even if they produce the same amount of oil or even more for that matter in some cases, they will end up earning lesser amount of money. But on the other hand, for companies like IOCL and HPCL who buy crude oil and turn it into petrol, diesel or jet fuel, this can actually be good news, because if crude prices drop but the prices of petrol and diesel do not fall immediately, these refiners make more money on every liter of fuel that they sell. Now that is a broader context. Now let's move on and talk about the quarterly results of some of India's biggest oil companies, because this will give us a lot more context to understand what's going on. Let's start with ONGC, which is India's biggest upstream oil company. See, ONGC had a very difficult quarter as expected. For the full year, it made a profit of roughly 35,610 crore rupees. Now I know that sounds like a big number, and it is definitely, but it was still 12% lower than what it earned in the previous year. And that makes it very clear. Now what's interesting is that this drop happened despite the fact that ONGC actually produced more oil than it did last year. So the problem was not really supply, but it was prices. But that said, there is more to this story than just price drops. See, ONGC is spending a lot of money right now, which is roughly 62,000 crore rupees on new capital projects to expand its oil and gas output. 38,000 crore rupees of that went to its core oil and gas business. The idea is that these investments will help boost future production. But apart from that, ONGC pulled off something very impressive this time around. See, oil fields become less productive as they become older. They're almost like oranges that keep giving less juice with every squeeze to some extent. But ONGC actually managed to reverse this decline by drilling more wells in the same oil fields, which means getting more out of the same exact resource. And because of this, they were able to maintain a reserve replacement ratio above 1 for the 19th straight year. And that basically means that they are finding more new oil and gas than they are extracting, which is a great sign for the future. ONGC is also trying to diversify. They are making a push into renewable energy and also looking to expand into chemicals, so they're not putting all of their eggs in the oil basket, to be honest. But for now, they are still heavily dependent on oil prices, which obviously shows up in their revenues. Anyway, one more very big hit that ONGC took this year was a write-off. ONGC had to write off 7,480 crore rupees worth of investments in exploratory wells, which are basically oil wells that they drilled but do not look profitable anymore. Basically, when oil prices were high, these wells made sense, but now they do not. So ONGC had to take that loss on their books. Their CEO was pretty blunt in their statement, where he admitted that the performance was pathetic in 3 categories, mainly due to these write-offs. But he also defended them, saying that exploration is risky but is still necessary. That is because unless they explore new areas, they obviously and intuitively will not find new oil. Now let's compare them to the downstream refiners like IOCL and HPCL, who had a much better time like I mentioned earlier. Let's start with IOCL. See, for the full year, its revenue was roughly 8.45 lakh crore rupees, which was slightly down from last year. But in the final quarter, they posted a massive profit of 7,264 crore rupees, which is a jump of 50% compared to the same time last year. HPCL did well too. They posted a quarterly profit of 3,355 crore rupees, which is up 18%, though its full year revenue dipped a little bit. The question is, what drove this good performance? One very big reason is refining margins. When these companies refine crude oil into petrol or diesel, they earn based on the difference between the input cost and the output cost, which is the difference between crude oil and fuel. Now this difference is called the crack spread or the gross refining margin or GRM, and that very margin jumped sharply in the last quarter. IOCL's GRM rose from $2.95 per barrel in the previous quarter to $7.85 per barrel in the fourth quarter. That of course is a massive jump. HPCL also saw its GRM rise from $6.95 to $8.44 in the exact same time period. Now, given the number of barrels they refine, even a small increase in margin can mean massive extra profits. Another interesting factor here was throughput. Both companies processed record amounts of crude oil. IOCL processed 70.5 million metric tons and HPCL hit 25.27 million tons, both of them operating at over 100% of their refinery capacity. Now, that is important because in this business, many costs are fixed like land, equipment, and also wages for that matter. So when they produce more, those costs get spread out and each unit becomes cheaper to produce. That basically helps boost their profits. But that said, there is also a marketing side to this. Both companies also sell fuel and other products like lubricants and chemicals. They earn margins here as well, and IOCL said that margins were positive, especially on non-fuel items. HPCL also outpaced the industry in sales growth. Its domestic sales grew 5.5%, while the industry on an average grew by 4.2%. But that said, there is another unusual boost that they got, which is something called inventory gains. See, because oil prices were falling, the value of the inventory that they had, which is the fuel that they had sitting in storage, actually rose when they recalculated it at new prices. So even though they had not sold that fuel yet, they were able to show that gain on paper. IOCL reported 600 crore rupees in refining inventory gains and 550 crore rupees in marketing, over 1100 crore rupees in total from just inventory revaluation. And HPCL also saw very similar gains. But that said, not everything was good. Both companies have businesses in chemicals as well, and that part did not do too well at all. Demand was weak globally, especially in big markets like China and Europe. And at the very same time, new supply from other countries flooded the market, which pushed prices further down. So chemical prices fell even more sharply than oil prices, and that turned these divisions unprofitable. HPCL's joint venture, which is called HMEL, which has a huge petrochemical presence, saw major losses. And that dragged down HPCL's consolidated profit by 25%, even though its standalone numbers looked good. And then there's another drag over here, which is the LPG business. See, the Indian government subsidizes LPG cylinders for domestic use. Companies like IOCL and HPCL have to sell them below market rates and then wait for the government to reimburse the difference. But the reimburse usually comes in very late. And in the meantime, these companies have to absorb the losses themselves. IOCL, for instance, took a hit of 20,000 crore rupees from LPG under recoveries this particular year, while HPCL lost about 10,900 crore rupees. And while the amount for HPCL is relatively lower, this particular problem hit HPCL a little bit harder because 90% of its LPG business is domestic, so almost all of it is sort of sold at subsidized rates itself. Now, the government did raise LPG prices by about 50 rupees per cylinder to reduce the burden on these companies, but that only helps a little bit. So if I were to summarize all of this quarter's results show a very clear divide in India's oil sector. Upstream players like ONGC struggled because of falling crude prices, but downstream companies like IOCL and HPCL managed to do fairly well, at least in the field of refining and marketing, by benefiting from lower input costs, better margins, and record processing volumes. But the picture is far away from being perfect. Petrochemicals are weak, LPG subsidies are draining profits, and future demand definitely remains uncertain right now. Now, of course, these companies are trying to adapt, diversify, and push for efficiency, but the problem is that they are still deeply tied to a global commodity that changes in price almost every single day. That brings me to the end of the two stories of the day. On that note, let's move on to the final section and talk about the quick news headlines. First, state-run BSNL has reported a net profit of 280 crore rupees in the fourth quarter of FY2025, marking its second consecutive profitable quarter for the first time since its inception. This follows a 262 crore rupee profit in quarter 3 of FY2025, and it contrasts sharply with the 849 crore rupee loss in the fourth quarter of FY2024. Second, BAT or British American Tobacco has offloaded a 2.3% stake in ITC Limited for 11,613 crore rupees through a block deal executed via its subsidiary Tobacco Manufacturers India Limited. The transaction involved the sale of 29 crore shares at a floor price of 400 rupees per share, representing a 7.8% discount to ITC's previous NSE closing price of 433.9 rupees. Third and the final one for the day, Chennai Petroleum Corporation Limited or CPCL, which is a subsidiary of the Indian Oil Corporation, has received approval from the Ministry of Petroleum and Natural Gas to begin retailing petrol and diesel through its own outlets. CPCL currently operates a 10.5 million tons per annum or MTPA refinery at Manali in North Chennai, which supplies products such as petrol, diesel and LPG exclusively to IOC. That's all the news and stories I have for you today. I hope you enjoyed this episode. This is your host Anurag Bansal signing off. Take care and I'll see you tomorrow. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.